A beginner's guide to technical analysis. Have you ever felt like the stock market is a complex choreography, with prices moving in a mysterious rhythm? Technical analysis, TA, steps in to be your interpreter. Unlike fundamental analysis, which focuses on a company's financials, TA dives into the world of charts and patterns, aiming to understand investor sentiment and predict future price movements. The imperfect market and the rise of TA. Imagine a perfectly efficient market where all information is readily available to everyone at the same time. Every investor would be on a level playing field, and technical analysis wouldn't hold much weight. But the reality is far messier. News travels at different speeds, some information is open to interpretation, and investor emotions can cloud judgment. This, imperfection, is where TA thrives. The language of charts. Technical analysts believe charts reflect not just price movements, but also the collective psychology of investors. Recurring patterns on charts are seen as a manifestation of these emotions: fear, greed, uncertainty. By identifying these patterns, TA practitioners aim to predict when these emotions might shift, potentially leading to price changes. Think of it this way: if you see a long line of people waiting eagerly outside a store, you might guess there's a sale or a popular product launch happening inside. Similarly, technical analysts use chart patterns to gauge investor sentiment and predict potential buying or selling sprees, which could influence future prices. A powerful tool, but not a crystal ball. Technical analysis is a powerful tool, but it's important to understand its limitations. Here are some things to keep in mind. Pattern recognition and false signals. Not every pattern leads to the expected outcome. Just like human emotions are unpredictable, market behavior can sometimes defy historical trends. Technical analysts rely on pattern recognition, but there's always a chance the pattern might not play out as expected. Beware of confirmation bias. We all tend to focus on information that confirms our existing beliefs. This is called confirmation bias. Be aware of this bias and don't get fixated on a single pattern. If you are convinced a certain pattern will lead to a price increase, actively seek out information that contradicts your assumption to avoid making a biased decision. A symphony, not a solo. Technical analysis works best in conjunction with other methods. Combine TA with fundamental analysis to get a more holistic view of a stock's potential. Fundamental analysis focuses on a company's financial health, future prospects, and competitive advantage. By combining these two approaches, you can create a more comprehensive understanding of a stock before making any investment decisions. Beyond the basics. The world of technical analysis is vast and complex. There are numerous chart patterns to learn, along with technical indicators that can be used to complement price analysis. As you delve deeper, you'll also encounter different technical analysis schools of thought. The takeaway: technical analysis can be a valuable tool in your investment arsenal. By understanding chart patterns and how they might reflect investor sentiment, you can potentially make more informed trading decisions. However, remember that TA is just one piece of the puzzle. Always conduct thorough research, consider other factors like a company's fundamentals and overall market conditions, and consult with a qualified financial professional before making any investment decisions. Ready to master the dance? The stock market is a complex dance, and with practice, you can learn to interpret its steps. Explore online resources and educational courses to refine your technical analysis skills. Conclusion: remember, The more you learn about chart patterns, technical indicators, and how they interact with investor psychology, the better equipped you'll be to navigate the ever-changing market landscape.